The U.S. just got downgraded again. Moody's lowered America's credit rating because, and I'm quoting, the U.S. has no clear path to reduce its massive debt burden.
Moody's has lowered the United States credit rating because of an increase of government debt.
Moody's is lowering its credit rating on the United States debt one notch to AA from AAA.
Moody's saying over the past decade, this situation has gotten worse.
This isn't just a headline, it's a wake-up call. Our national debt just hit $36.2 trillion.
U.S. national debt just surpassed $35 trillion.
That's $104,000 per American.
That's more than the national debt of Japan, China, and Germany combined. And it's growing by over $100 billion a month. Interest alone over $1 trillion a year just to stay in the game.
The United States' debt burden has been rapidly expanding in recent months, witnessing an increase of approximately $1 trillion roughly every 100 days.
Interest payments on the national debt just exceeded the Defense Department budget. They're over $1 trillion a year, just in interest.
We are borrowing money just to pay interest on the money we already owe. But here's what no one's talking about out loud. This downgrade isn't the main event, it's a symptom. It's a warning light on the dashboard. And the people who see it, the ones with real money, they're already gone. Warren Buffett himself is putting billions into Japanese and Indian equities.
Warren Buffett, on his 90th birthday, he purchased stakes in 5 Japanese corporations.
Blackstone just dropped $10.6 billion in a European real estate fund. And central banks around the world, they've been quietly buying record amounts of gold, not dollars, for the past 3 years because they know what's coming.
In the last 18 months, central banks around the world have been buying gold at a pace we haven't seen in over 50 years.
A weaker dollar, rising inflation, and a squeeze on the American middle class. This kind of squeeze makes groceries unaffordable, rent nearly impossible in most cities, and debt inescapable. In this video, I'm going to show you exactly what this downgrade really means, how it connects to inflation, rising interest rates, and credit card debt as a whole, and why this is already turning into the biggest wealth transfer of our generation. So let's get started with what actually happened. On May 16th, Moody's officially downgraded the U.S. credit rating from AAA to AA1.
Moody's is lowering its credit rating on the United States debt one notch to AA from AAA.
That might sound like a simple step, but symbolically, it's massive. Moody's was the last major credit agency still giving the U.S. a perfect score. S&P downgraded us back in 2011. Fitch followed in 2023.
The credit agency downgrading to the U.S. to AA plus from AAA. Now, the last time this happened was 2011.
And now Moody's has joined the team. For the first time in modern history, the U.S. is no longer considered a top-tier borrower by anyone. Why did they do it? Because the U.S. has no clear path to get its massive debt under control. The national debt is over $36.2 trillion, and it's growing by over $1 trillion every 100 days. Even worse, we're spending over $1 trillion in interest rate payments alone. That's more than what we spend on Medicare or the entire U.S. military. Moody's basically said, if you're running the world's biggest economy and can't even cover your own interests without borrowing money, that is a risk. And that risk hits you directly. Because when the government gets downgraded, you pay more to borrow money. Mortgage rates go up, car loans get more expensive, credit card interest rates continue to go up, and small business financing gets tighter. Think about it, if lenders don't trust the US government, they sure as hell won't trust everyday consumers. Treasury yields jumped just after this downgrade. The 30-year hit 5.03%.
For how much longer will we see this bear steepening of the Treasury curve? This move in yields that's led by the long end has captured our attention for so much of the last few weeks. But I want to show you just how stretched this move is. This is the 30-year yield versus its 200-day moving average.
This is the highest we've seen in years. That means Americans' cost to borrow just went up, and it trickles straight down to the rest of us. So this isn't just about credit scores on paper. This is about trust. And when the trust in the U.S. financial system starts to break, that's when the cracks really start showing. The top areas to invest inside a cycle like this is precious metals, raw land, and of course, entry-level housing. one that benefits inside of an affordability crisis. Let me show you something most people have not seen, a breakout moment in gold. The bull market in the 1970s, gold hit 200 separate all-time highs. In the 2000s, over 100 all-time highs. During the current bull run, only 74 so far. Gold has soared 1,233% since 2001. But mining stocks haven't followed. Exploration budgets have dried up. Major discoveries have collapsed, none since 2016. And supply is set to drop 17% by 2030. Wall Street is waking up. Just last month, John Paulson invested $1 billion in a gold mining project. That tells you something. Everything that I just laid out brings me to today's sponsor, AxeCap Ventures, stock ticker GARLF, where insiders have been buying shares. AxeCap Ventures was built to capitalize on this exact moment in the gold cycle. They control over 5.57 million ounces of measured and indicated gold, plus another 0.5 million inferred, currently valued at $5 an ounce, while peers trade for 8x more. Their Converse project sits at Nevada's Battle Mountain Trend, one of the richest gold zones in all of North America. A fresh drill program launched in March of 2025. Mario Vetro, co-founder and director, purchased 20,000 shares. Tyrone Breitenbach, the second co-founder and a director, purchased 50,000 shares. The team has a track record. Over 20 million ounces discovered in past ventures. AxeCap is cashed up with 10 million, trading at a steep discount to peers. Their model is simple: drill the properties, de-risk them, and position them for an exit at a higher valuation. If you're looking into the gold sector, this is one to research. AxeCap Ventures, stock ticker GARLF. Don't just take my word for it. Click the link in the description just below this video to see for yourself. Let's talk about debt, because this is the core of the problem. Right now, the US government owes over $36.2 trillion. So where's all that money going? Here's the brutal truth. Over $1 trillion goes just to interest, not roads, healthcare, or veterans, just interest on existing debt. It's like using a credit card to pay off another credit card while applying for a third credit card. And it gets worse every time the credit card interest rate goes up, because every new loan costs more. So now the Fed is stuck. If they lower rates, inflation will take off. If they keep rates higher, debt explodes faster. That's what a debt trap looks like. There's no clean and easy way out. They keep saying inflation is under control. You probably heard it 100 times. Inflation is cooling. We're down to 2.3%. But let me ask you something. Does it feel like 2.3%? Are your groceries that much cheaper than last year? Is rent going down? Are utility bills getting easier to manage? No, because the number they use, CPI, doesn't tell the full story. It's a formula, and depending on how you tweak that formula, you can make inflation look higher, lower, flat. You can paint any story you want. But what people care about isn't the formula. It's what they actually spend money on. And in the real world, costs are still rising. Food prices are up. Insurance premiums are hitting record highs. Rent in most US cities hasn't gone down. And thanks to the new tariffs, the average American household is expected to pay an extra $2,800 per year in just higher import costs. So even if CPI is cooling off, your wallet isn't. And when people can't keep up with higher prices, they stop saving and they start borrowing to survive. Credit card debt is already at a record high. More people are using buy now, pay later for basic expenses. Even Costco is offering payment plans on everyday household essentials and basic necessities. So while most people are just trying to pay the bills or wondering if now is a good time to buy a house or pay off a credit card, the wealthy, they're already making their next move. Warren Buffett is not putting money into US stocks right now. He's going international, investing billions in Japan. And when he's moving money like that, it means something. Blackstone, they just raised $10.6 billion exclusively for a European real estate fund, not an American real estate fund, Europe. And then there's central banks, not the ones making headlines, the ones quietly shifting strategy. They've been buying gold and cutting their exposure to U.S. Treasuries for the last 3 years. You think they're guessing? They're not. These are the people who move before things go wrong. They don't wait for a headline to tell them it's time. They watch the signals and act fast. All of this is why gold is back on the radar. It's not hype, it's not a trend, it's where people turn when they stop trusting the system. After the downgrade, gold jumped to $3,200 per ounce. And it's not just retail investors, it's governments, it's hedge funds, it's major institutions. They're getting out of paper and into something real. Look, you don't need to be an economist to see what's really happening. The US just got downgraded. Debt is exploding. Inflation is not really gone. Not by any stretch of the imagination. And people with money, they're not waiting around. They're already moving. This isn't doom and gloom. It's what happens at the end of an economic cycle. Trust fades, the system stretches, and the people that are paying the price are usually the last to realize it.